Reserves are huge. You have to have them, and I want to continue to accumulate reserves. I always want my reserve budget to be growing.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it.
Hey, welcome back to the show. I'm your host, Todd Dexheimer, and we got another solo podcast episode. I want to talk about a couple of different things. First of all, I want to talk about what top investors or top mistakes investors make when purchasing assets. And these are things that mistakes that I've made, mistakes that I've watched other people make. Certainly there's other mistakes that you can make, but these are kind of some of the top things that I think over and over I've either made or and have had, frankly, bad effects, right? Or other people have made and I've watched them make it and I see the effects that has been had on them, or I've talked to them about it and they say, this is why we didn't do well. So I'm going to talk about those top five. Maybe I'll sprinkle in a couple more, but talk about those top five. So first, I want to start with, and this, by the way, is real estate. It's probably some of it can be related to other types of investments, but this is real estate. And when we're talking about real estate investments, I think it's really important distinction to make too, that this is mostly commercial real estate. Most of it does apply to residential real estate, but there's other maybe bigger mistakes you can make in residential. So, but these are all big mistakes that you can make in either one. So, first mistake, and this one definitely applies to both, is location. It's really easy to get wrapped up into buying cheap. When I first started, this is where I was. I didn't have a lot of money. I didn't see the possibility to buy expensive properties. Plus, I was looking at cash flow. And so the cheaper properties were on paper going to cash flow better. And so what I would do is buy in some pretty rough areas. Now, I did fortunately understand that really, really bad areas I should not be buying in. So I did stay out of the really, really bad areas, even though I could get those properties for $10,000, $20,000, $30,000 for like a single family home, because this was during the Great Recession, right? This is 2008, 2009, where those homes in the worst of the worst neighborhoods were practically being given away. So I did stay out of those neighborhoods, but I was right on the fringes, pretty still not great neighborhoods, right? So I'm sitting here right on the fringes of neighborhoods. I was looking for neighborhoods that were right on the fringe, but had pretty low police calls. And so at least I was going, hey, I don't want a ton of crime. I want to make sure that these are good enough to where I feel safe going, and potentially even going at night. Now, in hindsight, here's what I'll say. So these neighborhoods, if they're the bad neighborhoods, look, you just don't want to be in them. Please stay out of those neighborhoods unless you truly, truly understand what you're doing. Those neighborhoods are not for the faint of heart, and I don't think they're for very, very many people. I just have a tough time ever recommending being in those neighborhoods. The fringe neighborhoods like I invested in, where the crime is much lower, but it's definitely lower income. It's definitely got some roughness to it, some rundown properties, that type of thing. You're talking like C minus, not the D class, which most people will never call anything D class, but there's definitely a lot out there. But these areas can be difficult as well. And so here's what I'll say about these areas, the areas that I invested in, and this is history repeats itself. It has proven it over and over and over every single time, is that when you invest in, C-class neighborhoods, what's going to happen is when a recession hits, when a real estate cycle happens, your property values are going to go down first. They're going to go down the quickest, and they're going to go down the most as percentage wise. And when that cycle starts to kick upward, your properties are going to recover the slowest. They're going to take the longest period of time to start to pick back up. They're going to recover the least percentage, right? And the least profitable. So where you can buy in a much better neighborhood and you can see maybe the amount of price that goes down more because, quite frankly, I mean, instead of buying a $100,000 house, you're buying a $300,000 house. So $100,000 price drop, versus a $60,000 price drop or whatever it might be. Value of price might drop more, but percentage wise, not even close. And they'll recover just a lot quicker, and they're also more stable during that period of time. So if it's a rental, you're going to keep your residents a lot easier, right? You're going to be able to rent it out a lot quicker. And so when you have those tough neighborhoods, C-class neighborhoods, and again, it doesn't even have to be high crime. It's just lower income, older properties, that type of stuff. What happens is it's tougher to find tenants for those buildings. It takes longer. They have less credit. They have more challenges. Most recessions, every recession that I've seen or studied, who loses their jobs? Well, a lot of people lose their jobs, but the people that lose their jobs the most are the lower end of the worker class. So you have that is your tenant in the C-class property. Unfortunately, that's who's losing their jobs more. And so, which is why there's more subsidized housing. Now, if you're going to do subsidized housing, that's a different story all in itself, right? You have to be good at that. You have to know what you're doing. You have to know how to deal not only with the resident, but you really have to understand how to deal with the government and that program and their expectations and dealing with just the little nuances of that type of housing. Now, that type of housing is definitely a huge need. And so kudos to you if that's what you're going to focus on. And even C-class, this is a huge need. But especially when you're getting started, I think that's a big mistake that a lot of people make. So, and by the way, what I think is probably the bigger mistake than anything on the C-class properties isn't necessarily that you can't make money in C-class. You certainly can. I made money in C-class, but I was buying these properties for super cheap and I was financing them for crazy cheap, right? The rates were super low and I kept on refinancing when they got lower. And so, I'm sitting here at mortgage rates today at like 3.5%, locked in for 10 years fixed. So I still got a lot of time left and the ability to continue to cash flow. My DSCR is crazy good, right? But what happens is you've got a lot more repairs and maintenance because your tenant base is just rougher on them. It's just how it is. You've got more move-ins, move-outs, just how it is, right? You've got more eviction costs. That's going to happen, unfortunately. And you've got older properties, so not only are the tenants a little bit rougher, but the properties are just older, so you've got more repair and maintenance based on that as well. And so the numbers on the paper typically don't align with the numbers that are reality. And so I see that over and over and over again. Like, we're going to make $800 a month, $700 a month, whatever it might be, and you end up making a quarter of that. And because of the type of property that you have and because of the type of location that it's in. Okay. So next thing is financing. And this one's a big one too. And this one is more pronounced in commercial because in residential, it's very common to get a 30-year fixed mortgage on your residential property, right? Your duplex, your single family rental, whatever it might be. It's pretty common to get a 30-year fixed. That's the most common type of loan out there, and that's a good loan, right? And hard to go wrong with that. Hard to go wrong with something that's 30-year fixed. Now there are instances where you might have to get like a hard money loan, or you might have to go with a local bank with a, hey, it's only 25-year AM fixed for 3 to 5 years. What I would say to those financing, just be really careful, right? Be really, really careful, especially with the hard money. I've watched people that, have hard money, that use hard money, that end up getting burned because they can't get that refinance done. So just be really cautious with the hard money, making sure you have plenty of equity, making sure you have plenty of liquidity yourself to be able to step in if needed. And then with the local bank, I would just say those are great avenues. And I did a ton of local bank stuff with, 25-year AM, 5-year fixed, 10-year fixed, whatever. But just the longer you can fix it for, the better, because time goes really quickly. And so I would fix it for a lot longer period of time. Don't do like the 3-year, 2-3-year. Do the 5-year, do the 10-year if you can. Something longer than that. And that's what I want to talk about with commercial. So commercial has a lot of different products. We have CMBS, we have agency debt, we have life cos, we have pref debt, mez debt. Those are basically supplemental debts. You have bridge debt, you have local bank debt. So there's just a lot of options with commercial. And I think is really important with commercial, no matter what you do, is I think it's so important to get debt that you can have fixed. And when we talk fixed debt in commercial, we're really not talking about a 30-year amortizing fixed debt, although there is a HUD loan that you can get that's 30 to 35 years, and that's a great product. However, there's nuances with that one too. There's difficulties with the HUD loan as well. But for the most part, we want to make sure we're fixing our debt for a longer period of time. And what we have, the difficulty with commercial real estate is when we fix our debt, when we have big prepayment penalties, which we don't really have in residential. When we do a 30-year mortgage, we can sell it 6 months later and it's not a big deal. Where when we fix in commercial debt, when we have like an agency loan or a CMBS loan and we fix that debt, it's great. However, we're kind of putting ourselves into a little bit of a pickle if we want to sell, because we have this prepayment penalty. Now, if you can do a step down in basis, meaning or step down prepayment, that's maybe better, because you know exactly your timeline. And so what I think is really important when you're doing commercial, and if you're going to do something fixed, and it's going to have a big prepayment penalty. A lot of times local banks won't have much prepayment, so local banks can be a really good option. But if it's going to have this big prepayment penalty, what you want to make sure is that the prepayment aligns closely with what your goals are with that property. So, and that can be really challenging, but we want to plan as much as we can. So for instance, if I have a business plan that says I'm going to sell in 5 years, I only want to fix that debt for 5 years, maybe max of 7. If I think there is a chance to hold it for 7 years, maybe max of 7. And then I would want to have that prepayment penalty, step down. So the first couple of years is going to be really high. If I sell in year 1 or year 2, I'm going to pay like a 5% prepayment penalty. That's going to be really big. But if I sell, towards the end, it's maybe a 1% prepayment penalty, or if it's at the very end, it's no prepayment penalty. And that's kind of what we're looking for to align with. And if you're saying, hey, we're going to refinance or whatever it might be, whatever your business plan might be, that's what you want to fix with your debt, is that kind of that term that aligns with your business plan. The most dangerous thing, I think, is, and this is lessons I've learned the hard way, is bridge debt. And bridge debt it's not fixed debt. It's floating rate debt. It goes with the market. So if the market goes up and down, and we've seen the market go up really quickly and really drastically over the last few years, and so interest rates, and so that played a big factor in how people could cash flow on their properties. And we've seen, you know, um, we've seen a lot of people struggle with cash flow and being able to meet their debt service because of that. Now, bridge debt does have, and you'll hear people talk, well, I bought a rate cap on my bridge debt, so I'm protected. Those are super expensive. And all a rate cap is truly prepaying the interest, the potential of the interest. So you're kind of making a bet that the interest in its insurance product. So this company's saying, hey, we're going to bet that we're going to make money over you. So we're going to sell this product to you for this price. And if the interest goes over that, we'll pay the difference essentially. Um, that's super expensive. And it's only locked in for short-term periods, right? It's only locked in for, usually you're only going to do it for 2, maybe 3 years. And then you have to buy another one. And so if you have a very short-term business plan, could it work? Sure, it could work, but it comes with a lot of high risk to it. And that high risk can really quickly burn you in the end. So I would highly suggest staying away from that unless there are some instances where I would be okay with it, but very few, right? It's bridge debt or a short-term construction loan is mainly for exactly that. It's for construction. It's for if you're going to buy a property and it's 50% occupied, it needs, huge capex, massive capex, 50, 40, 30, 40 grand a door in put into it. That's what that type of loan is for. And I would reserve it for that type of loan. Unfortunately, a lot of people were using that type of loan for just regular purchases with, kind of a minor value add. And they were using it as your primary loan product. And I think that's a terrible idea. I just don't think that's wise as an investor. So, local bank too can be a really good debt. That's typically personally guaranteed, but it can be really good debt. You can lock it in for longer term. I mean, we're getting 5-year or up to 10-year fixed, debt from local banks, 25 to 30-year amortization. So pretty good. Usually we're paid a little bit higher interest, but just really, really important to not make the mistake of putting the wrong debt on the property. So once you put the wrong debt on the property, you can really get burned really quickly. The thing I want to mention, that's the biggest, and I just did a podcast episode on this, but in my opinion, one of the biggest things that you can do with your debt on your property is have a high DSCR, debt service coverage ratio. And so you want to make sure your net operating income is 1.5 or even more times greater than your debt service payments. And that's going to allow you to cash flow. And that's super, super important when we're thinking about debt. And I see a lot of people getting tight on that. And that creates big time issues. And we all of a sudden have to pinch pennies and we can't do things to the property that we need to do. Along with financing, we've got the next mistake. Mistake number 3 is a poor business plan. I see a lot of people just with a poor business plan or no business plan at all. They don't understand what they're going to do with the property. They don't understand why it wouldn't work with what they're going to do with the property. They just have no plan, no real true plan with how this property is going to operate. They're just going to go buy it. And I see this more with residential operators than I do with commercial operators. But even with commercial operators, I see that they just don't have a good plan. And so they just buy a property because it's a good deal. It's got a low basis, whatever it might be. And it doesn't really fit with the rest of their portfolio. It doesn't really make a lot of sense to what they want to do and what their ultimate goals are. And they just don't think it through very well. They don't align their debt with their, ultimate business plan. They don't align their strategy, their renovation strategy with their ultimate business plan. They just don't have a plan, right? So everything is kind of just haphazard and nothing flows well together. If I'm going to sell a property versus I'm going to keep a property, Honestly, how I lease it looks different. How I renovate it looks different. How I finance it looks different. Everything I do looks different if I'm going to keep a property versus I'm going to sell the property. So make sure you've got a clear business plan. The next one, and this one's big, and I feel like we're seeing a lot of this, is just poor management. That's both asset management and property management. So asset management is more managing the property manager, and property management, of course, is boots on the ground. And I see really poor management, thinking that these third parties are going to do a really good job. By the way, some of them do an excellent job, but others do a horrible job. And so not doing your due diligence on third party property management, um, not thinking through your own property management. If you're going to in-house manage properties, how can you be efficient? How can you be effective? Can you be efficient and effective? Can you be a good leader? Those types of things. Can you do a good job with doing it in-house? What kind of issues does bringing it in-house potentially cause for you? I know some people, they I don't know that they'll admit it. I don't know that they believe this, but I've seen people that say they're vertically integrated. They want to go vertically integrated. So they start to go vertically integrated, and they realize the only way they can continue to go vertically integrated is to have more and more deals. And so all of a sudden they're forcing bad deals across the table to continue so they can be vertically integrated. So are you forcing yourself to do bad things by how you're managing the property? And so really poor management can derail what otherwise could be a decent deal. And you want to make sure you're being a good leader, right? As a business owner, are you leading well? Are the expectations set up the right way? And so, are you able to uh, have this spelled out business plan that everybody with the management team knows, including your asset manager, including the on-site staff, including your maintenance people? Everybody should know exactly what the plan is and how do we to achieve this plan. And then you need to continue to lead them to believe in that plan, to believe in the culture you want, and so you can have a successful management, I guess, plan along the way. And so, and your asset manager, do you have good asset management that's going to be really pushing that plan, that's going to be really pushing the culture, that's going to be really holding everybody's feet to the fire, right? Do we have good KPIs that we're following, so everybody knows what our expectations are, and how do we track those expectations, right? That's super important. It's easy to have an expectation. We want high occupancy, we want good residents, we want low evictions, but how are you actually tracking that? What kind of metrics are you looking at on a daily basis, on a weekly basis? And who's in charge of making sure that that's being followed? Who's in charge of making sure that there's some consequences if we're not following that, right? So you got to make sure those things are actually in place. And a lot of people don't have those things in place. What I see a lot of times, especially single family, smaller properties, is they hand it off to a property manager and they just kind of wash their hands of it. They think that that property manager is going to do the job. They don't have weekly meetings. They don't have monthly meetings. They have no meetings whatsoever. And they just assume that that property management company knows exactly what the expectations are. And all of a sudden things get missed. And I'm guilty of it too. I still hold some single families and duplexes, and I haven't paid nearly enough attention to them. I have a third party property management company on it. And that they haven't, in my opinion, they haven't done a great job. But it's my fault because I have not paid attention to it. I haven't had the weekly call, the monthly call that I should have with them. My expectations haven't been clear. They don't have a clear business plan. They don't have a clear direction from me of where to go. And so it's ultimately 100% my fault. And on any failure with your property is 100% your responsibility. And so anytime we have things go wrong, if we can sit here and blame it on our property management company, we can sit here and blame it on, the market or the tenants or whatever it might be. But ultimately, it's completely 100% our fault. We either didn't have a good business plan, we didn't have good financing, we didn't buy in a good location, right? We do we have poor management? Those are the types of things that happen that are ultimately our fault because that was our decision in the first place. And so we have to own up and have responsibility for it, and then figure out how can we fix it? Uh, how can we change our management? So that's number four. Number five is low reserves. I see this a lot. Is that you don't really have reserves set aside for things that might go wrong. And so this happened to me on one of the first larger properties that I bought. What happened is I closed on the property and a lot of things went wrong really quickly. Right. And so part of that was poor due diligence, but another part of it was some crazy things I just probably couldn't have predicted no matter what, no matter how much due diligence I did, other than saying, hey, look, this is an old building built in 1972, I believe. Look, this is an old building built in 1972. It's got deferred maintenance. I can tell by the current owners that they just haven't taken care of it, and the previous owners maybe didn't either. And so there's a lot of things that are going to go wrong on this building. So I need to put a lot of reserves to the side in order to protect myself from that downside. That would have been easy to do. I saw that. I did my due diligence. I knew that there was a lot of deferred maintenance that needed to likely take place over the next several years over my ownership period of time. And I had a 5 to 8 year plan. So a lot of those things were going to go wrong. And I needed to make sure I put reserves in for them. So I purchased the property and immediately the roofs needed to be replaced. We actually had a roofer up there that said they have 5 to 8 years left. Well, immediately they started leaking. 3 of the roofs started leaking. The owner, in my opinion, and there's no way to prove it, but the owner hid that. They were leaking prior to closing, and the owner was, doing patchwork and trying to fix things up. But regardless, I had to replace those right away. Luckily, I did budget for those. I said, I know these are old and they're going to potentially have to be replaced in my life. They're my ownership timeline. And so I budgeted for those. But then shortly after that, we had a bunch of plumbing issues happening where we had some of our subgrade units flooding because of plumbing issues. I had some plumbing budget reserved for that. But then we had a gas line burst underground. We had all kinds of other little issues going on, a bunch of exterior maintenance, some interior stuff, just lots of little things that continually went wrong, lots and lots of plumbing issues. And so we ate up our reserve budget really quickly. In hindsight, I should have reserved more. And as we purchase and we continue to purchase buildings built in the 1970s and 1980s, our reserve budgets are 4 times bigger than what I reserved for that property on a per unit basis. So we have learned our lessons from that, and not saying we can't still get in trouble. We certainly could. Like, more things could go wrong than what we ever anticipate. But happily now, we have huge reserve budgets, and we've been able to get by and be more than covered with those and have access cash. But I'd rather have cash sitting around in a bank and put it in a high interest bearing account than to just sit there and have to all of a sudden be scrambling and not knowing how can we make those repairs. So reserves are really big. I would say your minimum reserve account needs to be at least 6 months worth of principal and interest payments. But depending on the age of the property, depending on what you're doing with the property, potentially much bigger than that. So 9, 12, even 18 months could be a good thing. So reserves are huge. You have to have them. And I want to continue to accumulate reserves. I always want my reserve budget to be growing. So I want to continue to put money to the side. So I need enough cash flow to where I can not only cash flow, but have extra to be able to continue to build that reserve budget up over the years. And so I want to make sure not only do I start with a good, healthy reserve budget, minimum of 6 months, but I want to continue to build that. And again, the newer the property, a brand new property, could I have less? Sure. I'd be okay with a brand new property, maybe having four months. But as we get older and older, we want 6 months, 8 months, 10 months. We want to really look at what's going on with the systems of the building. Has all the plumbing been replaced? If all the plumbing's been replaced, that's a huge win, right? We don't have to go nearly as crazy with our reserve budget. Has all the HVAC been replaced? Maybe, so if that's been done, that's a great thing. Has all of the electrical been replaced, new panels, new wiring, all that kind of stuff, those types of things. So roof's been replaced, windows been replaced, so on and so forth. Uh, the very last thing, number six, I think I said five, but I got six, and this kind of goes with the last one a little bit, but um, renovations out of cash flow or not budgeting for your renovations properly. So that's really huge. I've seen it where people think they're going to renovate with cash flow. That never goes well. You're always behind. You're always struggling to actually renovate. You're struggling on your cash flow because you're renovating units, and so now you're not cash flowing as well. So now you don't have money to renovate. It's never a good thing. So over budget for renovations. I would rather have way too much money. Our budgets are huge on our renovations because we've ran into problems before with just being skinnier on our renovations. And we have to uh, skimp on how we're renovating units. We have to cut out some things we want to do exterior wise. It's just never a good thing. So our renovation budgets are definitely frothy. Um, but we want to make sure that we don't run into issues where, you're going to, by the way, you're just going to run into issues. And so we want to make sure when we do run into those issues that we can cover them and that we'll be okay. So that's super important as well. So um, big contingencies with those renovation budgets. So I want to try to call out every little thing that I'm going to renovate. By the way, you might go, oh, I'm not very good at, I don't know the construction side of the business. Okay, so during your due diligence, make sure you're running contractors through. Make sure you're getting quotes. That's extremely valuable to make sure you're getting quotes and setting aside that budget and then having big contingencies. When you get a quote and it's $50,000, you want to add 5% to that quote, 10% to that quote, depending on what it is, depending on how big, uh, how much, I would say, depending on how much could be hidden, right? So when we're talking about tearing into things and removing, maybe we're removing siding, well, you might have a lot of rot behind there, right? That's an issue. So I want to make sure we have, maybe 10% built into there. And then I want to over on top of that. So that's every individual line item, by the way. So when I get a quote for siding and it comes in at $50,000, it's going to be $55,000. I'm going to add 10% to that. That's from the contractor. Now I'm going to have on top of that an additional 15% contingency on top of my entire budget. Okay. So if my entire budget is 1 million, I'm going to add 15% to that. And that allows me to not only have a little bit of extra fluff on each individual line item, but that allows me to have individual or has project level fluff on the entire thing. So I've really added 20%, maybe even 25% to my budget to make sure I'm covered. Um, all right, plenty more that we could cover, but those are really the six big mistakes. I think I said five, but we're going with six now. Six big mistakes that I see real estate investors making. There's just so many more little things, but I think if you can cover yourself on these big six, you're going to do okay. You're gonna mitigate a lot of the big mistakes, and I think number one is understanding that you need to make sure you've got cash flow. If you've got cash flow, you can cover a lot of the other mistakes, and you can, even if you make these other mistakes and you've got enough cash flow, you can get out and survive. And that's the most important part. All right. That's all I got for today. You have a fantastic rest of the day. Make every day a Saturday.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.